M3. Okay. Now, last week I talked about the asset-backed bond, and I used the mortgage-backed security as an example. So I told you that, well, if you have banks, so you have several banks. So this is bank 2, bank 1, and they have a lot of mortgage. So this is M1, M2, for example. And the second bank, they have M3 and M4, right? And if they are investors like you and me want to invest in mortgage market, it's almost impossible because each mortgage is more than $1 million maybe, all right? And you are not a licensed bank, so you cannot, have a public mortgage. Of course, you can have private mortgage arrangement. There are some private equity firm. They set up a firm to lend out mortgage to, well, this is private market, not a public market, right? Of course, if there's a private mortgage, the interest rate, the mortgage rate will be high, all right? So in this case, you have a lot of homeowners, they have mortgage with the bank. And now more banks, they want to increase their turnover. They want to make more money, right? If you are the mortgage managers, you want to have more sales, you earn more bonuses, all right? So therefore, if there's a demand, someone will set up a special purpose vehicle. So they are the investment banker or large financial institution. So they set up this special purpose vehicle and they purchase the mortgage from the bank, all right? So they give them money, right? Give them money. And how do they get money? They issue mortgage-backed securities, MBS. All right? Now, there are other types of asset-backed bond or asset-backed security. We call it ABS. Right? It's not the ABS of the automobile. It's asset-backed security, ABS. Now, ABS include the mortgage-backed security, MBS. Right? So this is MBS. Now, it also includes what we call collateralized debt obligation, CDO. Now CDO, the structure is very similar to MBS, but in CDO, in collateralized debt obligation, well, the asset include almost any debt obligation. So MBS, so this is all mortgage. They're just mortgage, M1, M2. So we call this mortgage-backed security. Now, if the asset include, let's say, account receivable of Walmart, account receivable of another company, car loan from, let's say, Honda financing, car loan from, let's say, Toyota financing, now, or even credit card balance, right? Those credit card balance. So if the asset, they have all kinds of debt obligation, we call them CDO, collateralized debt obligation. So in this case, even you are a small investor, you can invest in account receivable of Walmart, account receivable of any large corporation. Because it's the special purpose vehicle, they purchase the account receivable, they purchase the car loan, they purchase the credit card loan, they purchase the commercial loan from banks or any other financial institution. And then use it as a collateral and then issue what we call CDO, collateralized debt obligation. All right? Now this process is called securitization. That is, you can turn an illiquid asset into a liquid asset. Right? Think about it. Mortgage. They are not traded. You cannot buy a mortgage on stock exchange. Right? They are illiquid asset. There's no ready market for mortgage. There's no ready market for account receivable. There's no ready market for car loan. But once we have this securitization, now all this MBS, all this CDO, they are traded either over the counter or on a stock exchange. So it becomes a liquid asset. All right, so this step, securitization, you turn illiquid asset into liquid investment. So now any small investor, if you want, you can participate in that type of market. All right, okay? So this is what we call asset-backed bond or asset-backed securities. All right? So the asset can be any kind of debt obligation. Right? And actually, this is a very big market. Freddie Mac, or that's one of the government set up agency, U.S. government set up agency, is one of the major MBS supplier, the mortgage-backed security supplier. Okay, or provider. All right. Now we also have direct placement. We talk about direct placement in equity issue. Now for debt issue, we also have direct placement. All right. Now there are two kinds of direct placement in a bond market or debt market. One is a term loan. So term loan basically is just borrow money from the bank. That's a term loan, all right, or any financial institution. Now private placement, the same thing. You just sell the bond to a small group of sophisticated investor or financial institution. Okay. So if you look at it, the direct financing, the flotation cost, the registration cost, they are much lower compared to public offer, all right? And usually they have more restrictive covenants because now you only deal with a few banks. So those banks, they will have a little bit more bargaining power, okay? But in case of default, it will be easier to renegotiate the term, because you only need to deal with a few banks or a few financial institutions, right? If it is a public offer, then you are dealing with hundreds of bondholders. You need at least 2/3 of the bondholder to approve your reorganization or restructuring. So sometimes it may be a time-consuming and costly process. All right? So that's the major difference between the public issue of debt and a private direct placement. Okay. The last thing we look at is syndicate bank loan. Now, syndicate bank loan, they are borrowed by normally multinational big company. Let's say IBM, for example. All right. So they may have a huge project, or they may have a new idea, new product. So normally the loan, they are talking about billions of dollars. So let's say if I'm a multinational company, I want to borrow $10 billion, it will be difficult to just get the money from one bank, right? Because of the risk involved, all right? So therefore, the banks will form a syndicate. So let's say Bank A will pick up, let's say 2.5 billion, Bank B will pick up another 2.5 billion, Bank C with 2.5, and Bank D 2.5. So in this case, even the loan amount is 10 billion, but it will be split over 4 banks. All right, so we call this a syndicate loan. Now the syndicate loan may be publicly traded, but when we say publicly traded, usually it's just over the counter. Right? It's just an over the counter market, like a dealer market, not a stock exchange. Okay? Now sometimes this syndicate loan may be a line of credit. That is, say for example, in my early example, I set up a $10 billion syndicate loan, but it is only a revolver or line of credit. So that means if I borrow this amount of money, you charge me interest. Let's say for example, interest rate is, let's say 10%. All right? Now, usually, if it is a line of credit, then I only pay 10% on the amount I withdraw. So let's say I take out, let's say $5 billion, or let's say maybe $6 billion. All right? That is, yeah, at the beginning, I don't need all 10 billion, but I arrange this line of credit. So in case in the second year or the third year, I need the money, I will have the money available. All right? So in this example, then they will only charge me interest 10% on the amount I withdraw. The money in reserve, in this example, let's say $4 billion, normally I will only pay what we call a standby fee. So this standby fee may be only 2% of the balance. All right, so that means if I do not withdraw this $4 billion, I only need to pay 2% on this balance. All right, so this is a typical example of a syndicate line of credit loan. Okay. Now, normally they are rated investment grade. That means they have high quality, good rating. All right. As I said, they are borrowed by multinational big companies. So that's why usually they have a very good high rating, investment grade. All right. So that round up the bond issue. Okay. So now you should be able to finish question number 2 of assignment 2. Okay, I noticed one student already submitted question number 2. Okay, but try to upload your answer as early as possible. Again, no late submission. The solution will be available immediately past the deadline. All right, because the exam is on April the 12th. All right, so that's only about 1 week.
Sir, and when can we ask for a regrade for the assignment? Like for example, for assignment 2.
But for assignment 2?
Yeah.
Well, once it's available, if you want to regrade, you have to do it quick. All right, you have to do it quick because after the exam, I only have 5 days to submit the final grade. So well, send me an email, or well, normally I suggest you send me an email, right? Write down why you think you need I need to regrade your assignment, and well, let's say for example, part B you believe I should get 10 out instead of 5, and part C and so on. So try to explain to me, all right? Okay, that's fine. Yes, submit your request. Okay. All right. Now next topic is leases. So a lease is just a contract between 2 parties. So one is a lessor who is going to lease the asset to the other party. The other party is the lessee, the one who is going to use the asset. All right, just like you lease your apartment, so you are the other one is the landlord, is the lessor, and you are the lessee. All right, because you are the one who use the property. But you have to make a periodical payment. That means you have to pay your rent, monthly rent. Okay? So the lessor can be either the manufacturer or it may be an independent lease company. All right? So sometimes you may lease the apartment from a developer. Right? Sometimes you may lease the apartment from an individual owner. Okay? Now for section 22.5, section 22.7, you don't need to read it. Basically, they want to talk about what discount rate you should use, and they also want to prove that leasing is the same as you borrow money and buy the asset. All right? That is, even you use lease, even operating lease. But as an analyst, when they analyze your company's financial statement, they will consider this lease is part of your debt. All right, so that's why when you apply credit card, they also ask you, well, whether you own your house or you lease your apartment, your house, okay? And they want to know what's your monthly rent you pay, or if you own the house, what's your mortgage payment? Because they want to know your liability, right? Your obligation, okay? So this 2 section, you don't need to read it, okay? And now one thing is, I personally believe this is the worst chapter in the textbook. Now, I'm not saying they're wrong, but they just have 2 different assumptions in the same chapter. I received the 10th Canadian edition last week, and I looked at chapter 22, and they still have the same issue. I don't know why. All right? Actually, it's quite obvious that they should change it. Okay? All right. Now, so this is the buying versus leasing, all right? So on this side, this is buying. So now firm U is the one who used the asset, and they are the person also own the asset as well, all right? So they finance the asset with their own equity and debt, all right? They purchase the asset from the manufacturer. Now, if this is a lease, then there's a lessor who purchased the asset from the manufacturer, right? So this lessor may be a subsidiary of the manufacturer as well, all right? And then they lease the asset to the user from you, Now, firm use the asset but does not own the asset. All right, and it is the lessor who own the asset. And how they finance the purchase of the asset? They use their own equity, and they also use the debt as well. All right. Now, to begin with talking about this, we have two important definitions: operating list and capital list, financial list, or finance list. Right? So they have different names for it. Right? Operating list is obvious, just operating list. But for capital list, financial list, finance list, they mean the same thing. Sometimes people call it capital list, sometimes people call it financial list, sometimes you call it financial list. Right? But they mean the same thing. So what are operating leases and what are financial leases? Okay? Now for operating leases, usually they are not fully amortized. All right? So that means the present value of the lease payment is not enough to cover the cost of the asset. So when you lease your apartment or your house, it is considered to be an operating lease because the apartment maybe or house may be at $1 million. But normally your lease term is maybe 1 year, 2 years. So when you count the present value of this lease payment, it's only a small amount relatively to the purchase price of the equipment or the property. All right? And usually it requires the lessor, the landlord, to maintain and insure the asset. All right? So in the company setting, it is the lessor who will provide maintenance and insurance. Now for operating lease, the lessee normally, may not be, have a cancellation option. That is, even before the end of the term, they can return the asset to the lessor. All right, and then stop the lease sometime. They have this option. Okay? Now for financial lease, capital lease, finance lease, normally this time the lessor, they do not provide any maintenance or any service. Okay? So you can think of a mortgage. A mortgage is a financial lease. Right? A mortgage is a financial lease. Okay? Now you are the homeowner, you provide maintenance, you provide the service to the property. Right? Insurance, everything. Okay? But the legal title basically is still under the bank's name. You only own the property until you pay off your mortgage. And the present value of your mortgage payment is equal to the purchase price of the security, the properties. All right? So financial lease, they are fully amortized. Okay? And usually, the lessee, even though the lease term is short, maybe only a few years, but they usually have a right to renew the lease at expiration. Okay? All right? And generally, they cannot be canceled. So if you do not make the lease payment, now they will file bankruptcy against you. All right? Now, let me just talk about the tax treatment of operating lease and financial lease. So on one side, we have this is operating lease. Okay? On the other side, we have financial lease. And we have two parties. One is the lessor, and the other one is lessee. And this one as well. Okay, the lessor and the lessee. Okay. Now, if it is an operating lease, so the asset will be owned by the lessor. So the lessor will claim the CCA. Because they own the asset, they will claim the CCA. All right? And the lessee, they will get a tax deduction for the lease payment. So L in this course or in this chapter, they represent the lease payment. L is the annual lease payment. All right? So that means if I'm the lessee, I pay $100, then this $100 is tax deductible expense. Okay, I can deduct this $100 from my tax return. Okay, all right. So this is operating lease. Now, if the CRA consider or classify the lease as a capital lease or financial lease, then this time it is the lessee who claim the CCA. Right? The lessee will claim the CCA. Okay? And the lease payment. So the lease payment, I will write the lease payment, let's say in the middle. Right? The lease payment. Now in this case, the lease payment is not fully tax deductible. Alright? So you can only deduct the interest portion of the lease payment. So this one is only interest portion. This is similar to mortgage. I hope you still remember in mortgage amortization, each mortgage payment, you have to separate into two. One, at the early stage, the majority of the payment, they are repayment of, or they are interest, right? And then the small portion is the repayment of principal, okay? So in this case, the same thing. Each lease payment, the first few years, there will be a large portion will be interest expense. So you can only deduct this interest expense. The repayment of principal is just you pay off your debt. So it is not tax deductible. All right? So only the interest portion of the lease payment is tax deductible for the lessee. All right? And for the lessor, this portion will be a taxable income. So this portion will be taxable income for the lessor. Okay? If it is classified as a financial lease. So this is exactly the same as the lessee buy the asset by borrowing money from the lessor. And then each year they pay interest, they can deduct the interest expense. Alright? So if it is classified as a financial lease, it is equivalent to borrow money and buy the asset. Alright? So there will be no tax advantage if this lease is classified as a financial lease by the CRA. Alright? So therefore in this course, all leases we deal with, they are all operating lease. That is, there's an advantage of using operating lease. Because in this setting, even I'm the one who used the asset, but I can transfer the CCA to the other party. Right? Lease payment normally is fixed. So that means you have a certain fixed payment every year. Right? Remember? CCA normally is a larger amount at the beginning because it's a declining balance. So you get tax refund earlier. Right? So that's a tax advantage. So let's say if I'm a lessee, my tax rate is very low or maybe even zero. So let's say I have a lot of loss carried forward, or I have a lot of other investment tax credit. So in the foreseeable future, well, I don't need to pay any taxes. So if you allow me to claim CCA, that's useless. All right, because I may not be able to claim or utilize those CCA. All right, so why don't I just let other party utilize the CCA? All right, and if they get something from it, they may lower the lease payment. That means we can share the tax saving together. All right, so that's the idea of why companies they use operating leases. So in this course, all leases we talk about, they are assumed to be operating leases. If they are capital lease, then there will be no tax saving at all. Because the CRA will say, okay, no. Even you do not own the asset, but it is a capital lease, you, as a lessee, you claim the CCA. Right? So it's the same as you buy it. Alright? I want to make clear to you that all leases in this course, we assume they are operating leases. Okay? Now, and a special type of lease to talk about is sales and lease back. That is, I have the asset, but I need it for my operation, but I just need some money. So what I will do is to arrange sales and lease back. So a sales and lease back actually is a two transactions together. One transaction is I sell the asset to you, and the second transaction is I lease the asset from you. Right? We combine into one contract. We call it sales and lease back, so that I can continue to use the asset and I have capital because I receive the money right away because I sell the asset to you and I make an annual lease payment in order to use the asset. Okay? Now accounting, I will go through this accounting issue pretty quick because actually if you look at IAS 17, it's only applied to lessor right now, alright? Because the IFRS 16 replaced IAS 17 in 2019. Okay? Now in the very, very old day, long time ago, no matter if they were operating leases or capital leases, you don't need to report it on your balance sheet. Alright? So that means if all my assets are leased from another company, my total asset is zero on my balance sheet. I don't need to report anything. I don't need to report any liability. Alright? But in 1979, the CICA, at that time called CICA, but now they changed the name, and they said, no, we should not allow this. Because if two companies are identical, one buy the asset and one just lease the asset, but they are exactly, the economic substance exactly the same. So why they have different reported net income? Assume the sales or the cost of goods sold, everything is the same. Then they should have the same bottom line, that is the reported net income. Right? Otherwise, investor will confuse, hey, one is better than the other one. But no, in fact, they're exactly the same. So they try to standardize the financial reporting. So they set up, that is, if it is a capital list or financial list, you need to capitalize it. Capitalize it means you have to report the asset on your left-hand side of your balance sheet, and at the same time, you need to report a liability on the right-hand side of your balance sheet. Because when you have a capital list, they are not cancelable, so you have a commitment to make the liability, to make the lease payment. So this is the same as you have a legal obligation, just like you borrow money. So you should report this liability, and you should report that you own this asset. Alright? Now this is accounting. So accounting and taxation are two different things. Alright? So maybe an asset in accounting, it is classified as a financial list. But in tax reporting, it may be classified as an operating list. It's possible. So don't mix up the two. Accounting and tax, they may have different classification. But most of the time, they are the same. But not 100% all the time. Okay? Alright? So basically, this is what we have. Alright, now in the past, the reporting is like number 2, that is operating leases. Alright? You lease the truck, you don't need to report the asset, you don't need to report any liability. Okay? For all kind of leases. Okay. Now, number 1 is the case when a company borrowed $100,000 to purchase the truck. Alright? So you report the asset and you report the liability. Now, nowadays, it depends on, in accounting, it depends on it classified as an operating list or capital list or financial list. If it is an operating list, this is the same as you don't need to report anything. Right? You don't need to report the asset, you don't need to report the liability. But if this is a capital list, then you should report your liability, asset and liability. So we call asset under capital list or asset under financial list. Right? But actually now they call it right of use, ROU asset, right of use asset. This is a new term they use right now, IFRS 16. So at the same time, you need to report your obligation under capital list, which is the present value of your future lease payments. Okay? So you can see, well, if it is a capital list, accounting, they are more or less the same as you borrow money and purchase it. Okay? Now the IAS 17, basically the rule is they look at whether it transfers substantially all risk and reward incidental to the ownership. That means the return and the risk, whether they go to the lessee or they go to the lessor. If they go to the lessor, then it is an operating risk. If they go to the lessee, then it is a capital risk or financial risk, accounting standard. All right. Now, according to IAS 17, there are several conditions that if you meet any one of the conditions, then this list will be classified as a capital list. All right. So the first few conditions is very obvious. The first one is whether the asset will be transferred to the lessor, all right, to the lessee at the end of each term. If yes, it is a capital list. All right. The second condition is whether there's any bargain purchase option. Even though the title still belongs to the lessor, but the lessee will have an option to pay $1 to buy the asset. So we call this a bargain purchase option. Now, in this case, we know you or the company will definitely exercise this option to pay $1 and buy the asset. All right. In that case, this is a capital list. Okay. Now, of course, there are exceptions. For example, if this asset has a huge amount of, let's say, disposal cost, all right, you don't want to buy it sometime because you pay $1 to buy it, but you have to pay hundreds of thousands of dollars to dispose it. Then definitely you would not. Okay. But in general case, if you have a bargain purchase option, now this is a capital list. Now the third one is look at the economic life of the asset. All right. Now the general rule is 75%. That is, let's say if the economic life of this asset is 10 years and the lease term is more than 7.5 years, then this will be classified as a capital list. All right. Now number 4 is look at lease payment, and the rule is 90%. That is, if you use the cost of debt of a firm to discount the future lease payment, and the present value is 90% or more of the purchase price of the asset today, then it will be a capital list. All right. So there's 4 conditions. The first 4 is very obvious. And later on, they add a few more. So say, for example, this asset is specialized for the lessee. That is, this is a specialized machine. All right? If you want to let someone use it, you have to make a major modification. Or you have to pay a lot of money to engineer the asset or modify it. Otherwise, they cannot be used by another company. Right? If that's the case, they consider, okay, you actually own this machine. All right? Now the remaining basically look at, well, what is, if you cancel the lease, who bear the risk of the residual value. That is the value of the asset at the end of the term, or when you cancel it. All right? If they are bonded by the lessee, then it will be a capital list. All right? So these are the arguments. So if you look at it, whether any one of it, if you meet any one of it, it will be classified as a capital list for accounting purpose, just for accounting purpose. All right? Now for tax, later on, next one, not this one, okay? Now nowadays, the IFRS 16, they replaced the IAS 17 for lessee, only lessee. Lessor, they will continue to use the same criteria to see whether it is an operating list or capital list. But for lessee, if you are the one who used the asset, now no choice. You have to capitalize everything, except the lease asset is less than 12 months, that's short-term lease, and the asset value is relatively small, right, immaterial. Then you can use operating list. Otherwise, almost all leases, they are capital list now. Now next, of course, is tax. That's the one we care, right? Finance, we care about cash flow. So accounting, they only affect your reported net income, earning per share, but not necessarily the cash flow. So for tax purpose, the CRA will look at it, whether the lease will be treated as a capital lease depends on this condition. All right, if you meet one or more of this condition, then they will be treated as a capital lease. All right, automatically transfer the title, that is the lessee. At the end, they will be the owner. All right, or the lessee is required to buy the property or the asset from the lessor, or there is a bargain purchase option. They just look at all these three. They don't care about whether this is specialized machine or the lease term, whether it's a 75%, or the lease payment, whether it's 90%. They don't care. They just look at whether, at the end, who owns this asset. Very likely. Okay? So let's make it one more time. In this course, we always assume all leases, they are operating leases. So that's why we have this calculation to calculate NPV of leasing. All right. Now let's look at the example in your textbook, page 608. Now they talk about, I believe they buy some kind of vehicle or truck. All right. So they look at each one. So each would cost $20,000 and assume there will be no salvage value after 5 years. And each will generate $72,000 for the next 5 years. And the CCA rate is 40%. And first they assume the asset class permanent. And the tax rate will be 40%. And the cost of debt is 11%. And now you have an option, instead of borrowing at 11% to buy the vehicle. So now you can lease it by paying $5,000 per year at the beginning of each year. Right? Now, the textbook also make the same assumption as in reality, lease payment they make in advance. That is the same thing. When you lease your house, lease your apartment, you have to pay the rent before you move in. Alright? So same thing in this course, we always assume lease payment, they occur at the beginning of each period. Alright? That means they are annually due. Okay, so you don't need to ask me in exam or midterm whether, or in the final exam of course, whether they make payment at the beginning of the period. That's our typical assumption. Alright? Now, in the textbook, in table 22.2, they present the tax shield of this asset. Alright? And since they still use the 150% rule, so therefore the asset cost is $20,000. So they multiply by 1.5, so that becomes $30,000, and apply 40% of the CCA rate. So that's $12,000. And since tax rate is 40%, so tax shield will be 12,000 times 0.4, which is 4,800. Now, in this table, they assume the tax shield occur at time 0. Now, this is the assumption they have. Year 1, 2, 3, 4, 5. This table assumes, so this is year 0, they assume that you purchase the asset at this point. Just 1 second before the end of year 0. So since you own the asset at year 0, because you buy it or you purchase it 1 second before, you bought it 1 second before. So you owned the asset at time 0, at the end of time 0. So you can claim the CCA tax shield of $4,800. So that's the assumption they have in this table. All right? So the CCA, the first CCA is right here. So that's why they call it CCA 0. And CCA 1, CCA 2, CCA 3, and CCA 4. So, and then they said, well, once you count using our formula, remember, the cost using this equation, the UCCN is equal to the initial cost minus 1 minus 1.5, since we assume 150% rate, right? So in this case, 4. All right, the CCA rate is 40%. Now you should get your UCC is $1,037, right? $1,037. Now, since the asset class terminate, then we have a terminal loss. So the terminal loss is the tax shield, right, from this. So it is 1,037 times 0.4. Now that will give you 415, all right? And then they claim that this is the time you sell the equipment. So that's why you have the service value here, although it's zero, equal to 0 initially. Right? So therefore, you have your TL. Actually, it's just TL because it's terminal loss. All right? So the terminal loss is, tax on terminal loss is 415. Now, this is the assumption of the example to begin with. All right? So as I said, they about assume 150% rule. That's the assumption in this course. Or actually, the next addition, the 10th addition, they changed to 100% rule, right? Because we know 2025 should be 100% rule. Okay. Now they about also assume tax shield at the beginning of each period. Okay. But don't forget, remember when we use the CCA tax shield formula that you use in from chapter 8, capital budgeting, and also chapter 18, right? Well, when we use that formula, we assume the tax shield actually happened at the end of each period. So that's the assumption we have. That is, you purchase the asset at this point. You do not own the asset at the end of time 0, year 0. You actually purchase the asset at the beginning second of year 1. All right? So you can only claim your CCA right here. This is your CCA 1. And then you can claim your CCA 2 here. And you can claim your CCA 3 here. You can claim your CCA 4 here. You can claim your CCA 5 here. And then you sell the asset at this point. Although in our example, the service value is 0. That is, you sell the asset just at the beginning of year 6 or right after the end of year 5. All right? So therefore, your TL is right here. Right? Even though we say, oh, it should be at the end of the year. But as I said, we assume that once you have a tax shield, you get the tax refund immediately. Right? So I know in accounting or in reality, you file your tax return next year. So you only get your tax refund next year. But in finance, 99% of the tax bill, we make that assumption. When you receive an income, you pay tax at the same time, immediately. When you make a payment, you get a tax refund immediately. That's the assumption in 99% of the tax bill. Okay? All right? So the red is the assumption we have in our CCA tax shield formula. Now, does it make a big difference? Yes, sometimes yes. Actually, in the example, they show a big difference. All right, so let's see what caused the problem, okay? Now, this is the cash flow they have. Okay, think about it. Now, this one, I want to make sure you understand the logic of all this, okay? About the payment. Okay, now, if you buy, that is, you borrow money and buy it. And this is your lease. Well, when you lease, I always need operating this. Now, when you buy this equipment, so this is a typical capital budgeting decision. So that means when you buy this equipment, you have to pay the cost, $20,000, right? If you buy it, you pay $20,000 today. But if you lease it, you don't need to pay anything, right? You don't need to pay anything. So now, this analysis is to look at if I buy it versus if I lease it. So we want to calculate the incremental cash flow if we lease the asset. So what is the incremental cash flow? That is this one minus the original cash flow. So 0 minus negative Z0. So that's why this is Z0. So the cash flow, that's why the $20,000 is positive. If you lease it, you save $20,000 today. So that's why it is positive, inflow. Okay? So this is different from a typical capital budgeting cash flow. A typical capital budgeting cash flow is this one. But for lessee, this is the cash flow because you don't need to pay. Alright? Okay? Now, next will be the lease payment. Now, if you buy it, you don't need to make any lease payment. Alright? But if you lease it, you have to make this lease payment. Minus L. You pay this $5,000 per month or per year. I'm sorry. So what it will be your incremental cash flow? This one minus this one. So negative L minus 0 equal to negative L. So that's why the lease payment is a cash outflow if you lease it. Alright? Now you get tax shield. You get tax shield. So if you, well, of course this again you don't have it. Alright? So the tax shield in this case is, well, you have this, okay, maybe I just use number rather than, okay, better example, 20,000. This is 20,000, right? So now this is, you pay 5,000, right? And the tax shield, in this case, if you lease it, now if you buy it, you do not get a tax shield, but now if you lease it, you can deduct $5,000 lease payment, you get $2,000 lease tax shield. So therefore, this is cash inflow. Alright? Okay? Now the next one is, if you own the asset, then you can claim CCA. Alright? So that you can have your CCA tax shield. So in year one, I just use year one. In year one, you will get a tax refund of $4,800. Right? Because you own the asset, then you claim CCA, you get a tax refund of $4,800. That's a CCA tax shield. And now, if you lease it, well, since it's an operating lease, you will not claim CCA, you will not get the CCA tax shield. So therefore, this is negative $4,800. All right? Make sense? Because if you own it, then you can claim, you get this tax refund from government. But now you lease it, you don't have it. So when you move from here to here, you actually lose $4,800. Right? Now, in this example, the salvage value is 0, but I can also want to include it as well. So if you own it, you should have a 0. This is salvage value. Alright, so in case this is just, in case they're non-negative, non-zero, then you push this number here. Right? But now since you lease it, you don't have it. So therefore, you also lose the salvage value. So in this case, it's just 0. Alright, but if it's not 0, then you lose the salvage value as well. That's a cash outflow. But in the example, we don't have it. Right? Now, TRTL. It depends on the capital CCA recovery or terminal loss. But no matter what, you should have the TRTL. So in this example, this is 415 terminal loss. You get a tax refund if you own the asset. But now you lease it, you do not have it. You are not entitled to this TRTL, this tax refund. So therefore, this is a cash outflow of 415. Alright? So this is incremental. That is, if we are here, we compare buying or leasing. So when we move from here to here, this is a cash flow. Now the $72,000 revenue is irrelevant because if you buy it, you have the $72,000. If you lease it, you also have the $72,000. So that's why this is 0. You can ignore the revenue. Right? They're irrelevant. No matter you lease it or you buy it, you still have the 72,000. All right. Okay. Now the discount rate, we have to discount everything back to time zero. Now the discount rate is the after-tax cost of debt because first of all, they are all after-tax payment, so we should use after-tax discount rate. And we should not use WACC, we should not use RS, cost of equity. The reason why is we compare leasing with borrowing. So what's the borrowing cost? The RB. So that's why we use the after-tax cost of debt. In this example, is 6.6%. Now you don't need to say, hey, if I buy it, I will pay interest. Now you don't need to include it because interest is already in here. When you discount it, you actually account for the interest expense in the discount rate. So therefore, you don't need to say, oh, I buy it, I have to pay interest. You don't need to worry about it. It's reflected or accounted for in the discount rate, which is the after-tax cost of debt. Okay? So if you're in this section, section 02, please line up, bring your student ID.